Welcome in, folks. It's a buy one, get three free in this one. 4 videos up for me to react to. First one up here. Avoid just buying S&P. Want to hear what this gentleman has to say? React to that, share my opinions there. Then this one, 2024 will be an abnormally normal year for the market and the economy. Okay, this should be interesting. So looking forward to getting to that one. Then we'll go ahead and react to this one from Courtney Garcia, who we're going to find out. Did she finally have her baby? $6 trillion in cash on the sidelines will come into play later this year. I have some pretty interesting opinions on that one, okay? Because it's something gets talked about a lot, the $6 trillion on the sidelines, okay? And then last up here, we're going to get into this one. Costco is still a winner, even in a higher unemployment environment. So looking forward to getting to that one. Appreciate y'all joining me as always. All I ask in return, smash a like. And make sure you're subscribed. That's it. Smash a like. Make sure you're subscribed, folks. Appreciate y'all being here as always. If you're looking to join my super investor group, then check out the pinned comment down there. You can apply to join us in there. Maybe we can get you in there either this week or next week. Get access to all my courses, Discord chat, all that good stuff. Alrighty, guys, let's get into this.
We're, losing a little bit of altitude, although still hanging in there okay. The S&P is up almost 5% year to date. Probably not many thought we'd be there 6 weeks into the year, even as we've reduced the amount of Fed easing that the markets is positioned for right now. What does it tell you, and what's the risk reward look like to you?
Wow. Well, Mike, I tell you,
Trade Desk TTD, what a good day there, 16%.
Risk reward is not good right here, and we certainly wouldn't just go out and buy the S&P 500. But like you said, you look at CPI, PPI. I mean, those were some nasty numbers if you're worried about inflation or if you're, the Federal Reserve. And the market's done really nothing but keep.
Wow, that's a pretty bearish statement right there. We wouldn't just go out there and buy the S&P 500. That's pretty bearish.
Grinding higher for the most part. So for us, we don't want to go out there and buy the S&P 500. We don't want to go out there and buy the Russell 2000, that's for sure. But I think there's a few things under the hood.
Whoa, he went way bearish there. Holy smokes, I was not expecting that. Then he said we especially wouldn't buy the Russell 2000. What?
Us, we don't want to go out there and buy the S&P 500. We don't want to go out there and buy the Russell 2000, that's for sure. But I think there's a few.
That's for sure. Oh, boy. Okay. Let me share my opinions on that before we go any further, okay? Listen. I think the Russell 2000 is a buy. I think it's been a buy. I think it continues to be a buy. Now, could it go down if you have some sort of big recession? Sure. But we could say that all the time. Literally, all the indexes could go down if you have a big recession. Like, that can always be said out there, right? And those happen every 5, 10 years, whatever. And it is what it is, right? But at the end of the day, is the Russell a buy? Are you going to be a happy buyer if you buy the Russell today? If you look out 5 years, 10 years, I'm pretty sure, yeah. Even the same thing with the S&P 500. I'm not the biggest fan of the S&P 500. I like individual stocks. But with that being said, if you told me I had to play in just cash or S&P 500, you know where I'm going, right? But, that's very bearish sentiment, man. Very bearish, this man is.
Under the hood that you can do.
Was it really nasty numbers, though, coming out of the PPI and the CPI? I mean, obviously more than you wanted to see, and it seems like there's at least a hesitation in this whole disinflation trend. But I don't know, what was it, 2% year-over-year core in the PPI?
Yeah, you can't complain a lot about that, and you're right. The trend in inflation is down. It's not going to move down in a linear fashion. There's going to be a few stumbles along the way. This is kind of a stall here, but certainly we have some confidence, and I think the market has a lot of confidence that inflation is going to keep crawling lower. So. That's why, after a week like we've had, really the S&P 500 is going to close pretty close to the all-time record high. I think the market's pretty comfortable with that. A lot of people would have said the market's very married to 6, 7 interest rate cuts out of the Fed. We're in the camp that we're going to see 3. And I think really, when the market digests that, it might digest it a little bit better than we would have anticipated because, I think the market's going to be pretty comfortable with 3 cuts this year.
Yeah, market was just flirting with 6 or 7 rate cuts, not married to it. At least it looks like that at this point. So if the S&P 500 doesn't look like it's at a great entry point right here for you, and the Russell 2000, which has started to come around, is also not, where would be?
Well, I tell you, here's what we're doing, Mike. We're taking the sectors that have really outperformed. And if you look at calendar year 23, it was tech, communication services, consumer discretionary that just dramatically outperformed the other 8 sectors. And of course, consumer discretionary's coughed up some ground here this year. But what we're doing is trimming from there. So we're taking, if our clients have been following our advice, they're overweight all 3 of those sectors. We're recommending that they trim back tech to a neutral, communication services to a neutral. We want them to take consumer discretionary to an underweight. And then we're taking those funds and we're looking at some sectors that haven't outperformed that we think will do well over the coming year. So industrials, healthcare, materials, energy. We made a swap with energy and financials. Financials ran a little too far, too fast. We backed off of that and ended up buying energy. We just don't think oil prices are going to go much below $70. So those are the things that we've been doing. But as I said, we've been avoiding just going out there and buying the S&P 500.
Sure, and I should mention we backed off a little bit further here. The S&P is down about 0.5%.
Yeah, so, I'll say this, in the short term, I'm actually not bearish on oil or oil stocks in the short term. And when I say short term, I'm really talking over the next 6 to 9 months. When it comes to me, like I usually have a long-term mindset. So when I'm talking short term, I'm usually talking in terms of months, right? And in the short term, I'm not bearish on oil. I think, for now, the economy looks like it's strengthening rather than weakening. I think at some point in time that will switch and you'll get a switch there, but that might be, 2025 or 2026. And then, certainly at that time, oil would not be the play anymore and it would probably go down quite rapidly. But for now, I think oil is actually pretty well set up, especially going into summertime. Will I play anything in that space? The answer is absolutely not. No, not interested.
It's an monthly expiration Friday, and here we are right at that round number 5,000 number. So, Scott, just real quick, it seems as if you're not necessarily saying the economy is really going to struggle here, or are you?
Well, Mike, I think probably we're going to see a couple of quarters, maybe the second, third quarter, where, you've got a 1 handle or right around 1 in terms of GDP. It looks like so far anyway, the first quarter's coming in okay. So we're definitely expecting a slowdown. When you and I talked, this time last year, we thought there was a pretty high probability of a recession. That probability certainly isn't 0, but it's a heck of a lot lower than it was, 6 or 9 months ago. So we expect to slow down. We expect the consumer to pull back here. We think the Fed, as I said, we're only going to get 3 cuts out of them this year. And so I think that consumer spending, higher unemployment, that's going to take a little wind out of the economy. And it's not going to be a disaster, but it's going to be a slowdown that's noticeable.
Yep. All right. We'll be on the lookout for it. Scott, thanks very much. Appreciate it.
Thanks, Mike.
Yeah, I was down the Strip this weekend, and let me just tell you, there's nothing going on down there in terms of like a big event. Obviously, the Super Bowl's long gone now at this point in time, right? So there was really nothing going on this weekend, and it was a zoo. It was a zoo down there. The stores, oh my gosh, were they busy. That was at the Wynn, and I was at Bellagio, and I was at the Forum Shop Caesar's Palace. I can just tell you, freaking busy. Restaurants busy, everything very busy, especially for this time of year. This is supposed to be like the dead time of year down there on the Strip. And it is just not dead, I can tell you that. It is freaking, for down there for this time of year, like February, no big events right now at the moment. And it is just, I'm telling you, man, zoo down there. Tables are busy, everything's busy. So I don't know, For right now, at least, it seems like spending is just fine. At some point, that will end, but it's not right now. I can tell you that. 2024 will be an abnormally normal year for the market and the economy.
And the impact on the markets as the markets try to figure out what the Fed will do and when. Here's what Atlanta Fed President Raphael Bostic told Sarah Eisen earlier on Money Movers.
My outlook is to start the normalization, start returning our product policies stance to a more neutral stance in the summertime, right? And I'll have to say, a year ago, 6 months ago, I was in the fourth quarter. So we've seen tremendous progress, and I'm hopeful that continues. If that continues, I'll be willing to pull it forward even further, but I want to see it continue before making that judgment.
You still think 3 rate cuts this year?
Well, That's what was in the dot plot. I was one of the 2 rate cut increases. Okay. So I'm still at 2. But if I pull it forward, if the data comes in more positively, I could move to 3 for sure.
All right, joining us now.
So, Bostic's at 2 to 3, cuts this year. So, once again, these Fed members are not in some sort of, let's cut like crazy, like I think a lot of people want them to be. They're just not there.
Markets, the Fed, inflation. Hugh Johnson, chairman and chief economist with Hugh Johnson Economics. Also with us, Ron Insana, CNBC senior analyst and commentator. Also,
which, by the way, and I've told you guys this before, this is so freaking important, okay? Listen, that's where we want them. If I'm telling you, if they start to feel panic, like they got to cut, I'm telling you, it's not good things for the market. It's not good things for the economy. It means we're screwed at that point in time, okay? And you better have your hedges in place by that time, because I can tell you that things are tanking. You want a Fed that is kind of like, we can cut a little bit. That's a Fed that is like, comfortable with kind of where we're at. If all of a sudden they're in panic mode and they're in scramble mode and they're talking about we need to cut, by that time you're donezo. You're donezo by that point in time, okay? So that's all I'm going to say. A Fed that cuts twice this year, that means we had a good economy. That means we had a good year in the stock market. That means inflation was in a pretty good place. That means things were fine. You tell me the Fed cut 6 times this year? Or cuts by 200, 300 basis points this year? That has to tell you, we had a market that started to tank heavy.
Chief market strategist at Dynasty Financial Partners. Ron, let me start with you. What do you, obviously the inflation numbers are a little hotter than expected, but coming down toward the target. They're lower than they were.
Well, I think the market's probably doing this, looking through the producer price report. 2.2% increase in outpatient hospital services is not exactly something the Fed controls from an inflation perspective. So I think some of the data, particularly for January, both for CPI and PPI, might be outliers. And it seems like certainly the stock market is more calm about it. Interest rates are up a little bit, but I don't think 1 month changes the assumption that we're going to see inflation continue to fall throughout the year.
Hugh, the markets seem to, apart from stumbling earlier in the week on that consumer price number, the markets seem to be motoring along quite nicely with interest rates right where they are. We heard an impassioned argument an hour or so ago from Mark Zandi that the Fed needs to move now, sooner rather than later, or it risks damaging the economy and hence the markets. Do you agree with that? Or why not just leave rates where they are if the desired effects are being felt? In other words, full employment is here or close, and low inflation is here or very close. Why change anything?
Well, Mark's got a pretty good point. He's got a pretty good point if you take a look at the numbers this week, particularly if you take a look at the retail sales and the production numbers this week. And what he's seeing, which I think a number of us are seeing, is that, look, we've kind of ruled out a hard landing. And I think it's a little bit early to dismiss that, particularly when you look at the numbers this week. And the second thing is a soft landing. That's very hard to rule out. And I think the consensus right now you'll find is that the expectation is we're going to see some pretty low numbers, first quarter, second quarter, third quarter, first and second for sure in 2024, down from those numbers like 4.9 and 3.3% that we saw in the fourth quarter. So Mark's got a good point. He's saying that the Fed's got to start to move now, or that the higher interest rates that we've been, quote, living with for quite some time now might have a more serious effect on the economy than most of us have in the consensus. It might be, I don't want to say a hard landing, but there is that possibility. You can't dismiss it.
Ron, meantime, obviously those hotter than expected CPI and PPI prints are out there, but we've gotten some disinflationary indications from the Q4 earnings number. Yeah. So, if you're an investor, how do you kind of square those two together? I know Q4 earnings are kind of backward looking, but as you assess guidance and various color from the calls and so forth, do you put more stock in that?
Yeah, to Hugh's point, we're seeing numbers that are softening up. And if you look at Atlanta Fed GDP Now numbers, we've gone from 3.4 to 2.9 in the latest estimate. So we're starting to see things soften a little bit. Now, 2.9 is still a good growth rate, clearly. But yeah, the companies are in many instances, kind of not having as much confidence that growth will continue at the same pace that we saw in last year's economy. So, I'm still comfortable that this is going to be an abnormally normal year as far as.
I don't know what stocks he's looking at, because I can tell you most of my stocks that I personally own they sound pretty dang optimistic for 2024 and expecting very strong numbers and very nice growth for their businesses in 2024. I can't even think of one company I personally own that is not expecting considerable growth in their top line this year, and likely even a bigger percentage growth in their bottom line. I can't think of one stock. So I don't know, what companies he's paying attention to or what he owns. And I'm sure there's plenty of stocks out there that are not going to grow their businesses and, are not going to have very good years and things like that. But I mean, I got a lot of companies that are expected to grow their businesses like 20% plus top line and even faster growth on the bottom line this year in 2024. So, it depends on where you're positioned in the market. If you know what you're doing, you know what you're doing. If you don't, you're in a world of hurt. $6 trillion in cash on the sidelines will come into play later this year, says Courtney Garcia. Let's see if she had her baby.
Of the tape, what to make of a market that so far has been tough to rattle, even in a bumpy stretch for economic data and with some signs of froth surfacing in its more speculative corners. Let's ask Cameron Dawson, New Edge Wealth Chief Investment Officer, and Courtney Garcia, Payne Capital Management Senior Wealth Advisor. Courtney, also a CNBC contributor. So welcome to you both.
Courtney had her baby. Nice.
Cameron, coming into this week, it was possible to say we had hit a lot of levels that said mission accomplished. 5,000 on the S&P, 18,000 NASDAQ 100. Bitcoin crossed above 50. We're looking for an excuse to maybe have a pullback. Many would have said, I would have said, we got one day 1.3% on that CPI number, and we picked it up. So is the market ignoring something, or does it show underlying strength? What's your read on that?
I think there is still very strong momentum in this market, and that there is still room for positioning.
Cam's always got the cutest outfits. Like, come on now.
Get more long. You're still in about that 85th percentile on positioning, according to the Deutsche Bank Consolidated Positioning Report, which just says momentum can keep on chugging along until you reach that point where you're at an extreme. I think the other important point is that it's not been about growth. There have not been growth fears that have been percolating, which just means that any kind of correction seems short and shallow and more to do with Fed expectations and really doesn't have that teeth in it that you would expect to see a deeper pullback.
Yeah, I mean, there's no doubt we've had enough months of pretty resilient economic numbers to suggest that we're not going to panic out when you have a slightly soft retail sales report, which is what we had there. And Courtney, I guess the question, too, is has the market answered some of the questions that people had for it? Meaning, I mentioned the Magnificent Seven down this week. I mean, Alphabet's down like 5+% on the week. Adobe's been tough. You had NVIDIA hanging in there, Semicap doing fine. But the average stock has done better over the last week. So the question is this another head fake? Does it show that we have something underlying here, or again, is it noise?
Yeah, and I think really investors have been rushing to those Magnificent Seven. Everybody thought this rally was going to broaden out, and this year that hasn't come to fruition. But weeks like this week are showing it may actually happen. There is still so much money on the sidelines. There's now over $6 trillion in cash right now. That's eventually going to make its way back into the market, because what's happening right now is, even though maybe with this...
I'm sorry, but that's just... No. Okay, there's $6 trillion in cash. And you guys know me, I'm an optimist, I'm a bull. But that $6 trillion in cash is not ending back up in the market. No. A small portion of that could end up back in the market over the next, few years. No doubt. But a small portion, like 500 billion, maybe $1 trillion of that money, right? But there's going to be multiple trillions that will stay on the sideline forever, just to be honest. If you look at the cash on the sideline numbers over time, it always is a number that builds bigger and bigger and bigger, and sometimes it decreases a little bit. Most of the time it increases over time, okay? And so, it's a little bit of a dream about this whole, $6 trillion is coming in the market. No. And by the way, I would be scared as crap if $6 trillion ever came into the market, because then where's the money left to buy? Then it's only downside from there, right?
PPI number. Inflation isn't going to come down as fast as people thought. It still is likely going to come down later this year, and so that money is going to come out of there, and it's going to go into some...
It's not going to come out of there. It's a great number to help you sleep well at night, I guess you can say. That there is all that money over there. There's a massive quantity of money that's over there, right? And it gives you some comfort. Allows you to sleep well at night. That's the biggest thing with that number. But is that... No. Okay, like I said, maybe 500 billion, maybe $1 trillion comes in the market over time, but no $6 trillion. It doesn't happen.
Sectors. What's happening is those Magnificent Seven are extremely expensive, right? I mean, just to put it in perspective how congregated these are getting, those 7 stocks are now bigger than the entire European stock market. Microsoft is bigger than the entire energy sector. I mean, people are rushed to those things. So with that cash coming off the sidelines, it's got to go into some of these other areas. You want to own the Mag 7, but if you haven't done anything, you're already overweight there. So you need to start looking at these other categories.
I did see, in the
cash always trash. So if you have cash not earning some sort of yield, then sure. But if you have cash earning, in a savings account right now, 4.5% or so, if it's treasuries, maybe it's 5%, or a short-term CD, 5%, I do not view that as trash. I view that as a prudent action to always have some money on the sideline. No different than the $6 trillion on the sideline. It's nice for you personally to always have some money over there on the sideline, okay? So, yeah, I don't view it as trash if it's earning interest. If it's under your mattress, then it is trash because they're going to consistently devalue your dollars over time. And even if you go into a recession, guess what? They're going to devalue that dollar even more. Something very important to keep in mind.
America's weekly kind of tracking of flows, there was some maybe 18 billion coming out of cash. I mean, a small amount, and you've had some flow. And the only real category of ETF equity inflows has been in tech. So I guess that's where the chase is happening. And Cameron, you did mention Fed expectations are the one thing that's really been moving around. And this has been a bit of a test case because there was a common line at the start of the year. It says, market's ahead of itself, thinking about 6 or 7 rate cuts this year. Turns out, yep, that's probably right. The market's now at 3 to 4, and yet stocks have held up fine. In fact,
the fact that people thought 6, 7 rate cuts, that means, listen, think about this logically for a moment, okay? You're talking about 6, 7 rate cuts. That means you're insanely bearish. That means you think the economy is going to crash and everything's going to go to crap. The Fed's not going to do 6, 7 rate cuts in a year unless the economy's tanking bad. They're not going to do that because inflation's coming down. No, that's not what the Fed does. The Fed only lowers that many times and that aggressively is if you're in a full-blown crash and they're like in panic mode. And if the Fed's in panic mode, you're in trouble. That means people just went in this year, once again, insanely bearish. That's 2 straight years.
Listen to what Raphael Bostic of the Atlanta Fed today said about kind of his stance on this and what he's expecting next.
We've seen a lot of progress in terms of inflation. I am expecting that through the course of 2024, it'll be a little bumpy. I think the trend will continue, but the path all the way to 2%, I don't think we're going to get to that number immediately. So these sorts of numbers, they're kind of okay, and I can live with it. And to me, it just says we just have to be patient and let's not get too far ahead and assuming that the job is done because there's still work to do.
I mean, and this has been a very consistent message. I mean, every single Fed official is on this page. And so I guess has the market proven that this is acceptable? In other words, as long as the next move is lower and as long as there's no economic emergency that they're not responding to, we can wait.
The market has been shrugging off a tighter Fed for over a year now. Over the course of 23, the Fed was consistently tighter than what the market expected, and yet valuations continued to expand. I think that the thing that would get the market to get more skittish around the Fed is if inflation truly did reaccelerate in a much more meaningful way, which means that we have to watch those prices paid in the PMIs. We've seen those tick up recently. Gasoline prices have started to move up about 7% over the last month. If that starts to move in the other direction, the Fed's tone will move from, yeah, it's okay, we're comfortable with this, to we might have to do something else, and all of those cuts priced in have to get priced out, and then maybe the market would wake up to that kind of risk. But that remains to be seen.
Yeah, fair. I don't really have anything else to add to that one there, okay? Costco's still a winner, even in a high unemployment environment.
Bring in Joe Feldman, Senior Managing Director and Assistant Director of Research at Telsey Advisory Group. Joe, great to see you.
Thanks for having me.
In terms of Walmart, I think a lot of people are expecting a pretty solid holiday season, but we will be getting some commentary potentially on, the month, the weeks after the holidays. What are you looking for?
Yeah, we're hoping to see that the consumer has stayed resilient. Walmart has described a consumer that's been trading down. They've seen more high-income individuals shopping at their stores, and then the lower-income shopper that they have has been trading down within categories. So we're curious to see if that's still the case. We're curious to see if traffic has sustained itself. They've been generating pretty good traffic relative to the rest of retail, and we think they were one of the winners for the holiday season. Now we just need to see them continue that into this year.
Joe, we're seeing layoffs across a swath of industries. It's not manifesting itself in the unemployment rate. I think it's a matter of time. But let's just say this is becoming a trend. Who wins? I think obviously Walmart wins this. But at Costco, for example, which theoretically should make sense, except that it's trading at close to 43 times next year's numbers. This stock trades rich, but is it too rich, I guess, is my question.
Well, I've covered that stock for over 20 years, and it's always expensive from a valuation standpoint. True. And yet that stock looks like the perfect stock chart you'd want to own for the long term.
He's 100% on Costco. As long as I've been in the market, it's always been an expensive stock. That's why I've never owned it. I've always loved Costco's business model. I've always loved the company, but it's always been like, oh, the valuation. Maybe it'll come down. Valuation and all along, it was always a buy. Same thing with Amazon. Amazon always trades rich. It's always a buy. Honestly, even Tesla, most of its life as a public company, it's always looked very expensive. And at the end of the day, it's always been a buy. NVIDIA is even another perfect example, right? Great quality companies are always going to trade rich.
I like Costco very much.
Company.
The more affluent consumer shops there, the middle income consumer shops there, they offer the best value, and you really do get tremendous good deals for the membership price that you're paying there. So I think.
Oh yeah, I was at Costco last night. I was there about 45 minutes before they closed. Holy smokes, man. It was like a rampage in there. Everybody was trying to get their stuff before they closed because they closed at 6 o'clock on a Sunday night. It was intense. You have no clue what it was like in that store. Oh my gosh, it was a zoo.
Costco is still one of the winners, even in that type of an environment where we do start to see, and we have seen some of these layoffs.
I'm curious, this is Julie. I'm curious what your thoughts are in terms of the importance of execution in this environment.
Look at Julia. She totally changed up her look. How about that?
As just being in a certain income segment, which is more important to you right now?
Well, I do think execution is key. And, the best retailers out there, the big guys like, Walmart, Costco, Home Depot, we see very good execution from these retailers. And I think that is something that people are focused on. Expectations for 2024, I think, have come down quite a bit in the past few weeks. I mean, we saw the stocks skyrocket once the Fed, sort of indicated a pivot. And now as they've pulled back on the timing of that, these stocks have started to level off and even pull back a little. So I think execution is going to be a big driver, combined with their commentary about how they see the year shaping up, which I think they're going to talk a lot about it being a back half weighted year from a consumer's perspective.
How does Home Depot look to you, Joe? You're saying that you think the first half of this year is going to be kind of challenging.
Yeah, no, I think it's going to be much of the same that we've seen the past several months for Home Depot, for Lowe's, Floor and Decor, that whole home improvement side of the market. Everybody wants to see the housing market ease up and get a little better. I know home values are high, which is generally a good indicator for Home Depot and Lowe's, but the spending has been challenged. And I think it's because, people aren't able to borrow against their homes. They did a lot of big projects during the pandemic that you don't have to do right now. And so they're being more cautious with how they've been spending. And so we're probably going to see similar trends first half of this year. And second half, hopefully that starts to ease up a little bit. And that feels like, those stocks got a little bit ahead of themselves again with that, since that move from December till today. I feel like they feel a little pricey for where they are at the moment.
Yeah. So the bottom line is, if you told me I had to buy Costco stock or Walmart stock, which one would I buy? The answer is I would buy Costco over Walmart. Even though they both are trading too rich for my blood. I mean, Walmart's trading at maybe 23 times, 24 times, something like that. This year's expected numbers for Walmart, I think that's just too pricey. Costco is also trading too pricey. But with that being said, if you force me into one, like I got to go with Costco as somebody that's a long-term investor. And so, yeah, no, that's kind of my perspective there. They still got quite a bit of growth for Costco. That's an amazing thing. You'd think this company's so established, like they don't have any. No, they still got a lot more growth ahead over this coming years, especially in China. Okay, appreciate y'all joining me as always. Thanks so much for being here, folks. If you're looking to apply, join my private group. Check out the pinned comment down there, folks. Join myself and the super investors in there. Much love and have a great day.